All right, so option basic. So first thing we have are calls. So calls are basically just betting that the price is going to go up. That's a bullish position. Puts, you're betting that the price is going to go down. That's going to be a bearish position. Now buying an option, so you can have a lot of different things that can be a factor. But let's just say you're buying a 270 call. The stock price goes up to 290 from 270, so that's 30-point move. You would be in the money and you can exercise or sell your option. So what it basically means is exercising an option is buying back those shares, and that one contract is equal to 100 shares. You're buying back those shares, and you can either sell them or convert them to a long position. So let's say you bought a 270 put. Price is at 270, you're at the money, and the stock price goes down 220. So either you can sell the contract or you can exercise it, get those shares short, which is very risky, and buy those back for the profit of having the 100 shares. So if you don't have the money to leverage 100 shares of this, we'll say it's BABA, and it's worth 270. You don't have the money to leverage 100 shares of 270. This is a thing that goes into margin, where you borrow money from the broker, or depending on what brokerage you have, they can automatically just close it out for you. So they can have their risk management team buy the shares and control when you sell it. Usually on Fridays, when your options exercise, they hold it and then sell Monday, which is still pretty risky. So generally what I do is close out before expiration, or 5 days before, where theta won't start to affect the price as much. But we'll go into strike price and expiration. So picking a strike price, you can either choose out of the money, which is further away. So you're betting that this is BABA, for example. You're betting that BABA is going to reach 330 by December 11th. So you have 6 days for that to happen. So if we dive a little bit deeper, you can see it's cheaper. It's $25. 0.25 times 100 is $25. $25 to have the right to own 100 shares of BABA. Now, if it reaches 330, then you'd be able to buy this position in. Now, if it's exercised. Now you have theta. As time moves on, this is per day. So as a day passes, you lose $9 a day. And as it gets closer to expiration, the higher this goes. Delta, the other one that I focus on, is every dollar that the price rises, you get $2 in premium. So it adds on $20, it goes up $1, it's $27 now. If we do the quick math on it, so if it rises up, let's see, 265 to 330. 330 minus 265. If it goes up $65, then we're going to multiply that by 2. That's $130 on top of your $25 investment. So that's $155 there if it was to reach 330. And that is theoretical. So as it gets, or theoretically speaking, but if it gets closer, so you can see as the price of BABA, as it gets closer to your strike price, your delta goes up. So you can see our delta is 50 being here, so close to our stock price. It is substantially closer, and your theta also increases as well the closer it goes. Those are two things to watch out for that I like to look for. The downside to picking a strike, so if you get at the money strike, like a 267.5 call, it is going to cost a lot more premium than just going out just a tad bit. And that's something you can calculate how much the price usually varies by looking at the implied volatility, which is 36.71% on BABA. They're expecting a plus or minus 10.63 move on the stock price. So that means it can move down $5, it can move up $5 within this week time frame, or it can just go up $10. And this is all just a speculation. This isn't. This is based on probability, pretty much. Now, let's say you bought a longer expiration. You have 104 days to expiration, March 19th, 2021. This is another downside to picking a far or long dated option, either, well, mainly being that the premiums are so high. So you're paying $2,000 for one contract. But on the bright side, your theta is a lot less. You lose a lot less. As the time goes on, you lose less money. Or you lose $10 rather than losing $50 being at the money on a weekly. The implied volatility is substantially higher, so around 41%, because they're expecting the price to move at least $47 plus or minus $47 within this time frame. This is all calculated. I wouldn't base it off of that, but yeah. So let's say your contract rose and you began to fall back in this blue area. So this is intrinsic value. So as you go in this zone, then your theta becomes a lot less and your delta increases as well. So you get more money. Like let's say you bought a 2 call on Tesla that had an expiration date of 2023. So you'd be a millionaire, but the delta on that contract would probably be a guess of $10,000 per every dollar move or something crazy, because how far it is deep in the money. Okay. No, what's going on? Okay. So, what's up here? Okay. All right. So diving a little bit more into detail with a weekly versus a long position. So we'll do something that makes it a little bit easier for me to understand is I had to make a decision if I wanted to get the 2018 call, or I'm sorry, the December 18th call on BABA versus the January call. So I went here, I found something pretty affordable, did a lot more than just that, but went on there, found a few contracts I liked. Let's see, we'll go to the January one. And the January one, more expensive, but obviously that implied volatility is up, so it's expected to make a higher move. So the price is expensive, but pretty much same exact contract, same price, but just $30 more, and that kind of negates out the implied volatility there. But okay, so I went on here. This is just a visual. I don't really do this often, but this is how I kind of assessed the risk and looked into, is it worth buying a riskier option? Is it worth buying generally a safer option. And this is what I looked at. So I know that I have a price target at 280 and another price target at 305. So what I did is I went to the option price when it was worth 280, and I saw, okay, so at this top of the peak, 280, the option price was 373. Okay, 373 at that price, and I went over to the next contract, which is less risky because it has a longer expiration date. And I saw 243. So the difference between that is you get less money with less risk and more money with more risk. Right? So let's say it hits the price target of 305 by expiration. So within 14 days or 15 days. So up here, our contract would be worth $3,000. Almost double, well, yeah, double the amount of our safer option. So there's less risk with this, but less reward as well. So I kind of had to pick and choose which one I wanted to pick. Obviously, keep in mind on stop losses. I'm not using stop losses personally, but for this trade, but I had to kind of pick and choose. And there's a lot of other indicators you can use out there. I don't really want to dive into detail on the indicators I use or really what they mean, but to me, this looked like a fairly good trade to enter, and I was initially in this contract at 66 a while back, and I decided to close out that position because I took profit way too soon. There's just a few things that you have to learn about that, but generally this the key thing about it is to just assess your risk, make sure that you're picking and choosing correctly, and yep. All right, cool, I gotta go.